Good afternoon. Thank you for joining us for today's webinar, Unclaimed Property, Avoiding Penalties from Increased State Enforcement. I am Bob Sharon, partner and leader of the firm's tax practice. I'm pleased to introduce you to today's presenters, Tom Corey, principal at Friedman, director of the firm's state and local tax group. Tom has more than 30 years of experience and has worked with clients in a broad array of industries and advises high net worth individuals with respect to both their personal and business state and local tax matters. Also joining us is Alan Goldenberg, a member of the state and local tax and tax controversy groups. He focuses on tax transactions, including structuring, advisory tax services, and tax controversies. Alan has more than 10 years of experience representing taxpayers before the IRS and local tax authorities. Friedman is a leading provider of accounting, tax, and business consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry and all regions where we operate. Friedman's State and Local Tax Services Group is dedicated to helping clients avoid pitfalls and maximize their tax position in light of widespread tax changes. We are pleased to bring you programs such as today's Unclaimed Property webinar and will continue to share insights to help you navigate the complex and evolving tax landscape. The goal of today's program is to help you minimize your exposure to potentially significant penalties for non-compliance with unclaimed property laws in the face of increased state enforcement. Our state and local tax experts will provide guidance on establishing a sound unclaimed property reporting process that will help your business reduce liability, meet reporting deadlines, and remain compliant throughout the year. Now, at the conclusion of the webinar, we will attend to questions from our listeners. You can submit your questions and communicate with us throughout the course of the webinar using the Q&A feature on the lower portion of your screen. We would also be delighted to schedule time to speak with you on a one-on-one basis to better guide you on your particular situation. And now, at this time, I'm pleased to turn the presentation over to my colleague, Tom Corey, who will kick off the program. Tom?
Thank you, Bob, and thank you, everyone, for joining Alan and I today with respect to this webinar. I think when we get started, I just wanted to lay out a framework of why the states are so interested in unclaimed property. Unclaimed property, the states estimate that somewhere between 65 and 90% of the companies that should be filing unclaimed property returns are not filing unclaimed property returns. For example, the states are now holding between $50 and $60 billion of unclaimed property. In fiscal year 2015 alone, the states have collected $7.75 billion, and only $3.25 billion was returned to the rightful owners. That is a breakage rate of close to 60%. The states are very interested in collecting this money because they feel that it is a very politically correct way outside of taxing for them to fund certain revenues, given the fact that they have such a high breakage rate. One thing to consider is that certain states' unclaimed property collections represent a very significant part of their budget. Delaware, for instance, where 80% of the entities are formed in the United States, unclaimed property represents the third highest part of its revenues raising. California, it's the fifth highest. The state that is holding the greatest amount of unclaimed property currently is New York, with about $13 billion. Because there is such non-compliance and because the amount of monies that are available are very, very significant, the states are really looking to push the unclaimed property area. And in that vein, and as Alan will talk about as we go forward, are engaging third-party auditors on a contingent basis to to address unclaimed property. This is something that these auditors will spend many times several years going back, looking through records, and coming to some conclusions as they get paid a percentage of what they see, fined rather. Alan, you want to start the presentation?
Sure. So I think to begin, and as you mentioned with the non-compliance, a lot of businesses don't understand what unclaimed property is. So unclaimed property is property that is typically tangible or intangible that's held by a business that has been abandoned by the owner for a specific period of time, which we'll discuss in further detail. All 50 states have unclaimed property rules, as well as Washington, D.C., various territories of the U.S. Puerto Rico has specific unclaimed property rules, and these rules do vary by state. We'll touch upon some of the more famous examples in each of these states later on in the presentation, but it's important to understand that each state has its own specific rules when it comes to unclaimed property. The concept with unclaimed property is that funds that have been abandoned by its owner should be held by the state as a custodian until that owner is found and that property can be returned. So why is unclaimed property important? It's important because, as Tom mentioned, it's the law. All states have rules on their books, and it's an obligation upon all holders and businesses to be compliant with unclaimed property. In addition, there are no statute of limitations. States can go back to the beginning of time to when the business started operating to look for unclaimed property. And as Tom mentioned, finally, there's much audit activity going on in this field, and we've certainly seen an uptick with the use of third-party auditors receiving contingency-based fees. It has really increased the area of activity within unclaimed property itself.
It's important to remember that unclaimed property is not a tax. Basically, it's based on states' property laws. So anything tax-related, in essence, doesn't apply. Concept of nexus, apportionment, and statutes of limitations do not really apply. Also, in many cases, you don't have the administrative levels of review that would be available to you in a tax context. Again, because audits can be rather extensive, and we don't have statutes of limitations, and you have periods where the property has to be considered abandoned, which could be anywhere from 1 to 5 years or more. Sometimes in audit context, the states or auditors will come in and look back for records that could be 15, 20 years old, oftentimes are not available. The holders no longer have them. Alan, you want to talk about the Unclaimed Property Act?
Sure. So under the Unclaimed Property Act, holders and the states have different obligations and responsibilities. When we refer to a holder, we are talking about a company or a business that is holding unclaimed property. Okay? Their obligation is to review their records to identify the property that has become unclaimed or abandoned. They also have an obligation of due diligence to try to find the property owners. And if the property owners cannot be found, they have a reporting and remitting obligation to the state. The state, in turn, has a publication requirement whereby they must list those individuals with property outstanding. They must provide them the necessary means to apply to get those funds back from the state. And the state is also required to safeguard those funds until the rightful owners can be found.
I think it's important to note, as I mentioned earlier, that there is a very, very significant amount of breakage rate with respect to unclaimed property, meaning that a very significant portion, up to 60% or more, is not ultimately returned to the rightful owners. The states use it oftentimes to plug budget gaps that they may have. They oftentimes keep it not segregated, but in a general fund, and they will pull from those funds when a rightful owner comes forth and can prove they are indeed the rightful owner.
So Tom, another key concept when it comes to unclaimed property is what's called the dormancy period. And that is the time required, and it varies by state, that the property must go untouched for it to be deemed unclaimed. Once that point is triggered and the property has not been claimed by the rightful owner, that's when there is an obligation on the holder to remit those funds. It's important to point out these are only funds that are in the ordinary course of a holder's business. So the one-off items or extraordinary type items that sit on their holders' books or records don't necessarily fall within the category of unclaimed property.
There are many different types of common types of unclaimed property. We've listed a few of them. Obviously, payroll checks, accounts payable, vendor checks, gift certificates, accounts receivable credits, security deposits, bad debt expense accounts, etc. Escrow accounts is another one. And one of the things to remember is each state addresses these things in a different way. For instance, some states will look to gift certificates or cards as unclaimed property. Other states won't. Oftentimes, that's not the end of the equation. For instance, with gift certificates, New Jersey takes the position that if you sell $100 worth of gift certificate that goes unclaimed, only 60% of that, or $60 in my example, is escheatable to the state, because that represents, in its estimation, a cost of goods sold. So when you sell a gift certificate, you immediately are entitled to the profit of that certificate. What you are enriched by, if someone doesn't claim, is the cost of goods sold regarding that certificate.
Tom, you also want to talk about another big exemption out there that many states have, and that's the business-to-business exemption.
Right, Alan, you want to mention that, because some states have it and some states do not, and there is, significant deviance with respect to how it's applied.
Right. So, so oftentimes states will allow an exemption when there are credit balances between businesses on certain items. So business A gives a deposit towards something to business B, and those deposits sit on the books for a certain period of time, the dormancy period, and they go unclaimed. States sometimes will allow that property to not be deemed unclaimed property. Really, the focus with unclaimed property in many states is on individuals, not necessarily businesses, and therefore the state allows such an exemption when it comes to business-to-business transactions.
What are some of the high-risk factors that businesses can look to that say, hey, we may be in trouble with respect to unclaimed property? We may have quite a bit of it. In situations where you have high employee turnover, oftentimes I found in fast food type industries where, for instance, you have people that are making minimum wage or somewhat close to that, and they are there at the business sometimes for 3, 6, or less than a year period. Oftentimes, that's a situation where you're going to find a lot of unclaimed property in the payroll area. Also, when you have a company that does business with a large amount of vendors, they have, or they're in a situation where they have a large amount of customer deposits, large accounts receivable credit balances. Oftentimes, we found that credit balances stay on the books for years, and people don't even think they have the issue. One thing I want to mention, Alan, is that I've been doing this for a long time. 15 years ago, I would go in and see some major companies and talk to them about unclaimed property, and they either say, we don't have any, or we take it into income. Folks, you can't take that kind of unclaimed property into income. It has to be escheatable to the state. And the state's looking at this, and if you've got a fairly large company, even not so large, and you think you don't have unclaimed property, the auditors come in, they will find unclaimed property. Alan?
Right. It's certainly problematic when unclaimed property is taken into income, because what typically happens is that businesses will pick up that income on their tax return and pay taxes on it. And without a statute of limitations for unclaimed property, if they're ever audited and funds are found to be unclaimed property, they have to be remitted to the state, and there's no way of claiming a credit or amending their tax return, I should say, to try to get a refund for taxes paid on those unclaimed funds taken as income.
That's a great point, Alan. You get whipsawed. In other words, you've already showed it in income and paid taxes on it, and yet it has to be escheated to the state on audit. What are the basics of unclaimed property? Who or what state is entitled to the unclaimed property? Basically, that is based on some Supreme Court decisions, the key of which is a case called Texas v. New Jersey, in which Texas and New Jersey obviously were arguing over who was entitled, which state rather was entitled to receive certain escheatable property. And the Supreme Court laid down a list of priority rules. Primarily, the state that has the top priority is the state of the last known address of the payee. If you do not have that information, then it becomes escheatable to the state of the holder's domicile. In other words, your state is formed in New York, under New York law. New York is your domicile. If your state is, if your corporation is formed in Delaware or your LLC, the domicile is Delaware. We should also be very clear here that a sheet is something to worry about for not only corporations, but other forms of business entities also, limited liability companies, partnerships, and everything else. The requirements are generally a annual reporting requirement. Some states even require that if you have no unclaimed property to report to them, they require a report to be filed. Those are known as zero reporting states. Alan, you want to talk about the due diligence requirements?
Sure. So each state has its particular form of due diligence, but each contain a number of the items we have listed here. Some states have a dollar threshold whereby due diligence isn't required. If the outstanding property or the unclaimed property is $50 or $25, that bypasses the due diligence requirement. Many states have a timing requirement whereby a due diligence letter to the last known address of the owner has to go out. Typically, that's 60 to 120 days prior to the reporting date. Other states, depending on the type of industry that the holder is in, say an insurance company or a bank, there may be a publication requirement. I think many of us have seen this in the newspaper. There'll be an insert with a whole list of names and addresses with the disclaimer, property may be out there in your name, and to search for it. Finally, some states have specific language that has to be included. We typically tell our clients to ask for proofs of identification to make sure sending those funds to the right individuals. Some states also require notaries to notarize the claim, to make sure, again, that those funds are paid correctly. When it comes to the filing deadlines, most states do not file a tax year filing. April 15th, for example, or March 15th is not necessarily an unclaimed property filing deadline. Typically, states either have a May 1st or November 1st deadline when it comes to filing an unclaimed property. And similarly, these unclaimed property reports usually list out in detail the names, the addresses, the last date of that you tried in payment to those owners, as well as the amounts of that's owed to those individuals on a schedule. But sometimes those funds are small in sum, sometimes they're less than $50, in which case states allow an aggregate reporting. You can lump those all together and report just as one lump sum.
The NAPA codes that we're looking to here, in other words, the types of property that when you file your report, they are filed according to what's called NAPA codes. NAPA is the National Association of Unclaimed Property Administrators, and they have put together a list of different types of property. In other words, payroll, accounts payable, accounts receivable, etc. And again, I mentioned that some states require the filing of negative reports, even if you don't have any unclaimed property due to that state. What does it mean for property to become unclaimed? Each state has a little bit different rules in this regard, but in essence, there's a period of time in which there has been no communication or other contact with the particular owner or the payee of the property involved. There's been no, the holder should verify there hasn't been any increases in the owner's account. They've gotten no written communication, and the owner has not expressed in any way any interest in the property at issue.
You know, Tom, we've seen situations where a payee may have multiple accounts with the holder. There may be activity in one of those accounts, but not in another account. If that were to be the case, the account that did not have activity occurring in it is not unclaimed. As long as there is a communication between the parties and one account is active, then all of the accounts are considered to remain active for unclaimed property purposes. The following page here, we've listed, we provided a chart of the various examples of unclaimed property and the dormancy period. For the most part, payroll is a one-year holding period. So states that are on a calendar year basis, you would have to wait an entire calendar year until they become unclaimed, at which point they would be included on the next unclaimed report. Another thing we see quite often are accounts payable and gift cards. As you can see mentioned here, there are some states that exempt gift cards from unclaimed property, but those that do include gift cards and unclaimed property, they usually have a 3 or a 5 year dormancy period.
And Alan, just to mention, some companies have tried to avoid the gift card situation by setting up gift card companies in states that don't consider gift cards to be escheatable property. I think Virginia is one of them. The other states are looking at those very closely. It's almost like in a tax context, the old intangible holding companies that used to be set up in Delaware.
So we'll now move into the compliance process. We've given you here the 5 steps, and we'll delve into them in detail. But for a holder, the first is to compile the reportable transactions. The second step is to remove any of those that are exempt. And then once we have the property that is in fact unclaimed, we move into the due diligence requirement. Then businesses and holders will hear back from those owners of property, so they can have to reconcile those claims. And finally, the remaining items are what becomes escheatable to the state. So in terms of compiling a report, the first thing we tend to tell businesses to look at is to review their internal audit reports, their general ledgers, their trial balances. These are typically areas where we'll find the stale accounts. Bank accounts, we see those that are open and closed that remain outstanding. Typically, those are areas of interest when we come in to review clients' books and records to determine where unclaimed property may be lying. Payroll, for example, is a big area. For us that we've seen, oftentimes you'll have checks that are sent out to employees that may have left the business. That final check goes uncashed, and those tend to become unclaimed property.
Alan, today, a lot of businesses are used to direct deposits. So, folks may think that payroll isn't an issue, but depending on the type of business involved, as I said, where you look to businesses that have, high turnover rates and people that may move addresses fairly frequently, you could have a situation where there are a lot of payroll checks outstanding. And interestingly enough, those checks could not be individually all that much, $25 here, $50 there, but altogether they end up being thousands of dollars.
Another area that we often see unclaimed property is in accounts payable and accounts receivable. We mentioned this earlier, but we tend to review items that accounts that were voided and picked up into miscellaneous income. Again, we explained before that's problematic with the tax being paid on that. You do want to review the void check register. Those items tend to become unclaimed property within 3 to 5 years. And we also have accounts receivable. You have aging credit balances that sit on a company's books for significant periods of time that are just rolled over year to year that are in fact unclaimed property.
Again, this slide here deals with gift cards, most of which are anonymous. Different situation if you have a known address. You've got an anonymous gift card. In most cases, that is going to be escheatable, depending on the laws, the state where the gift card was sold. And then you have a situation where you have to look to the law of the state to see how much the state is looking for you to escheat of that particular gift card. Before we go on, before we enter determining liability, I want to just mention a couple of things. One, when we talk about dormancy periods and how long the audit is going to go on for, if the state typically is, when you say you have a 5-year dormancy period, so what that means is that you're going to be looking to 6 years prior to the reporting year to see what property in that year is still unclaimed. The other thing is many companies do not have extensive records going back. And since you've got this dormancy period, and if you are picked up on audit, there are no statute of limitations in many cases. You have situations where states could be looking at records from 15 years or greater back. If they can't find, oftentimes, situations where you've got a state, which is your home state, Delaware does this all the time, because as I said, 80% of the entities in the United States are formed in Delaware, and the unclaimed property provides a very significant part of their revenues annually, they will use what's called an estimation fraction. Since you don't have the records to determine the liability from those unknown years, they will look at the known years, come up with a fraction of what your accounts receivable, et cetera, was determined to be unclaimed property, and apply that fraction on the revenues that were generated in the earlier years. So it can be quite daunting if you don't have extensive records in this area. Alan?
Yeah, so just continuing forward, to determine liability, the first step is really to look at the outstanding checks. You take those outstanding checks, you see what has been voided, and that which has been voided and never satisfied, the debt has never been satisfied, ultimately becomes unclaimed property. One of the other areas we see which proves problematic time and again is payroll, particularly when you have third-party administrators. And in those situations, unless you know for sure that the third party is in fact filing and remitting unclaimed property on those uncashed payroll checks, it's incumbent on the business to ensure that those funds are properly remitted to the state. So that is an area of concern. When it comes to due diligence reporting, the goal of it is to identify the owners of the property, and the requirement is on the holder to take that initial initial steps to get that done. Reasonable efforts have to be made to reach out to those owners, to locate them, and to ultimately get them their funds. States require two modes of doing that. The first are mailings, and that is, again, like we said before, there may be some exemptions to that or thresholds, but the states require that letters have to be sent out to those individuals stating that the holder has these funds on its records and is waiting for these individuals to reach out to them to send them their funds. States also have a publication requirement in newspapers. Not every state requires that. It's industry specific, but that's the second mode of reaching the most broad audience possible in hopes of finding those owners. In terms of the due diligence letter, there is specific language that has to be listed in that letter. The first is to notify the individual outright, upfront, that there is this existing property. You have to notify the owner that if they don't claim these funds within the specified time period, the funds will be remitted to the state. And then you also have to provide the instructions that the owner needs to take in order to reach out to the company and obtain those funds.
In terms of when to report, majority of states have a reporting date of November 1st. Maryland has a reporting date, interestingly, of October 31st. Other states may have a spring due date of May 1st. There are a few. I think Texas is in July. You need to look at the individual states' unclaimed property laws in that regard. There are penalties for late reporting. Usually it's not compounded. Certain jurisdictions, California, Puerto Rico, have a two-step reporting process. You have to file a preliminary report without any remittance, and then usually close to 6 months, 7 months later, the final report will be due.
And Tom, it's also, some states have different reporting due dates based upon industry type. So, New York, for banks, there's a November 10th date. For utilities, though, it could be October 10th. It really varies.
And the forms of report, are again mandated by the individual states. Most states want some form of a computerized filing, except in situations where you have a de minimis number of items, you know, to file to them. Many states have opted on for certain filings via electronic software that's commercially available. Some states require that you upload the reports actually to their individual websites, and there are a few states that require the reports to be sent to them via CD or a flash drive.
We get a lot of clients of ours asking us, why do we have to file in so many states? Let's just lump all this property together into one state report. Let's just remit it to the one state. It'll cut down on the timing. We'll send out due diligence letters, but at least this way we can clear all these funds off of our books at one time and be through with our reporting requirement. And unfortunately, that's not permitted. There is a reciprocity agreement. It's called the National Reciprocity Matrix among the various states that for the most part, states do not allow for reciprocity. So you cannot lump in South Carolina unclaimed property on a North Carolina report. Sometimes incidental property can be included. We've listed a couple of examples here, but this does come up often when we're doing voluntary disclosure for clients. Maybe a business has not been filing its unclaimed property reports, would like to begin that process, similar to tax situations where we have voluntary disclosure. We can do that for unclaimed property, and oftentimes businesses will want to lump all their unclaimed property into their state of incorporation. That often doesn't work, and there are limitations as to when that could be available.
Right, Alan. Moving on to self-assessment best practices for businesses. I guess the first question is, what kind of reporting has the business been doing all along? Is it in compliance with the laws of the states where it's holding unclaimed property, or does it even know whether it's holding unclaimed property? Again, situations with unclaimed property don't generally involve statute of limitations. So, businesses that are holding unclaimed property or think they may be or haven't taken the trouble to look into whether they are can find themselves in trouble when they are presented with a very large unclaimed property bill that's unexpected, and particularly in situations, as Alan described earlier, where they've already taken that property into income and paid taxes on it. Also, I think a business needs to look at its current record retention policy and how far back have they been holding their records for? Are there any material checks that are outstanding that have been out there for a while? Do we have a policy? Does the company have a policy of writing off these credits or checks? And is there some form of a de minimis write-off policy that the company generally follows? I think most companies, and some states require this. Alan will talk about this later in the voluntary disclosure process, but some states require that before they will admit you into the voluntary disclosure programs for unclaimed property, you must have some form of a best practices or procedures set in place, a unclaimed property manual. You need to create a timeline for due diligence processing or report filing. Most of the states require that prior to sending in the report to the state, you have to send out due diligence letters, and usually that's somewhere 90 to 60 days prior to the date the report is due. You need to develop some form of strong internal controls and review all your suspense items and aged items. Alan?
Yeah, and what we've seen for the most part for many businesses that we've done unclaimed property services for, they don't have internal controls. They don't have manuals set up for the most part, and that's why we're here today. Oftentimes, businesses are not aware of their unclaimed property obligations. So certainly setting up a manual internally, having a timeline whereby those in an accounting department, are looking out for certain items, reviewing those stale check, reports. That's really the first step in the best practice for compliance purposes. Once you've developed that methodology internally, you can move into the due diligence and start reaching out to those individuals and trying to get a hold of them in hopes of doing your best to returning those funds.
One of the things that, oftentimes happen is a company acquires a new business, and if they're not careful, they also inherit the unclaimed property liabilities of that particular business. That's part of a due diligence requirements that should be done when you are looking in legally whether you're going to acquire that business. Alan, you want to talk about voluntary disclosure a little bit?
So now that we've scared all of our listeners out there, and we've given them a little bit of a background into unclaimed property, those out there in our audience who have not filed or are completely unaware of unclaimed property are probably wondering to themselves, what do they do now? And the answer is voluntary disclosure. As I mentioned before, similar to income tax, states virtually across the board have voluntary disclosure programs whereby a business can come forward, reach out to the state, and request admittance into the program. The benefit is that there is a limited look-back period. As we said earlier, unclaimed property audits can go back to the beginning of the business operation. But under voluntary disclosure, those periods are typically limited to about 10 years. The benefit also is that there'll be a waiver of any associated penalties with the funds that eventually will be remitted. And in some states, they'll also waive the due diligence requirement, which does cut down on a lot of time and fees, though you are in agreement with the state that going forward, you will be abiding by the due diligence requirements of those states.
Alan, interestingly, in these voluntary disclosures with unclaimed property, you're generally going to get an abatement of interest also, as well as penalties.
So the reason that voluntary disclosure is a good option is, if you sit back and wait for a state to come and audit you, it really opens a business up to quite a lot of exposure. Certainly, if there's a decent amount of unclaimed property on the books. As I said, the voluntary disclosure limits a look-back period that a state can go to audit. But if they come and get to you first, there is no look-back period. And as we know, businesses don't retain records going back more than 7 years, maybe 10 years, and that's where the real pitfall becomes. Because what states will do is they'll develop an estimation, and they will estimate those back periods for which records are not available. For the most part, businesses typically grow year to year. So the way your business is sitting now financially is not the way it was 20 years ago. And if they're going to apply the same ratios and estimations based upon today to 20 years ago, that could really produce a large liability that can be avoided had a business chosen to do voluntary disclosure.
Right. I think that's one of the reasons voluntary disclosure is so important with respect to unclaimed property. The other thing to remember is not every state has a formal voluntary disclosure program. Some of them do, and they have it right on their websites. Other ones have what they call informal voluntary disclosures, and you have to request to enter that program and push the right buttons. There are a few states that don't have any form of voluntary disclosure, and you have to request a waiver of penalties and interest via a letter.
So just to wrap up, some trends that we're seeing in the unclaimed property area. We touched on it before. Third-party auditors. This seems to be a big one. They're contingency fee-based, and they are really increasing their activity by state. We have a lot of audits by first priority states. Most states are incorporated in Delaware or New York, and because under the Supreme Court, New Jersey v. Texas ruling, if the owner's address is unknown, they have first claim to the property. So they're incentivized to really increase their audit activity. And typically these audits go on for many years. They want to get as much out of the business as they can, and it tends to allow for third-party auditors and first priority states to really push the audit envelope when it comes to businesses.
What we can do, we are basically well-versed in unclaimed property. We carry on voluntary disclosures in multiple states for large companies and small companies. We have a robust due diligence letter processing ability. We have automated software that will, kind of do soup to nuts with respect to unclaimed property. Now, I'd like to start addressing some of the questions that we've received. We got a couple of questions here regarding gift cards. One was, what happens if the gift card has an expiration date? Generally, folks were trying to do that to avoid having to remit that card to the states. Various states have taken different positions on that, and I know Delaware, I think, was a pretty aggressive position on that, and they weren't allowing it. So it depends on the state law, but I would say in many cases, if you see a situation where you're going to become unjustly enriched, according to the state, by holding that money, it's likely that the state is going to be looking for it, unless the state has a specific exemption for gift cards. In terms of, we had another one here. Someone said, did I say unused gift cards are not included in unclaimed property? I said no. Generally, they are includable in unclaimed property. Certain states have exemptions for them, but only with respect to percentage of the card. So usually, if you think about it, when you sell a gift card and that gift card is not redeemed, you are enriched by the cost of goods sold in connection with that gift card. You have already realized the profit on it, and the state is looking for the unjust enrichment, which they consider to be the cost of goods sold. New Jersey takes a position that there is a 40% profit margin on the gift cards, and they are looking to collect 60% on the cards.
We've got another question here. What happens if the payee is from a foreign country? That falls back, and where does that property get sourced? Under the New Jersey v. Texas Supreme Court ruling, the state of priority for that would be the state of incorporation of the business. So when you don't have the contact information, or the information is not within the United States or any of the territories, the default then is the state of incorporation or domicile of the holder of the property.
There is also a question here. It said, if a company has a policy not to issue refund checks if accounts receivable credits are not claimed within a certain period, time period, can they recognize the unclaimed refunded as credits as revenue? I would think generally no. It's kind of trying to plan around your unclaimed property liability. And again, you're looking at to see whether you are entitled to the funds at issue. It may change, or rather on a state-by-state basis, but based on what I've seen When I've done a situation with companies like this and I've faced audits, the answer to that question is no.
Another question here talking about checks that are payable to either a federal or state agency and what to do about those in terms of unclaimed property. We've seen those included on some holders' ledgers, and you really do need to make the best efforts to send those back to the state agencies. Oftentimes those are taxes that are owed or certain fees that are required to be paid. Those really don't fall within unclaimed property. They're really owed to the state agency, the taxing authority. So we typically push our clients to make their best efforts to remit those funds directly to the agencies or the states themselves.
Question here, on average, how far back do states look to on unclaimed property audits? A couple things to remember here. Statute of limitations generally aren't an issue. Also, you've got third-party auditors operating on a contingency basis, and they're very aggressive. I've seen situations where they will look for records that go back 20 years. For instance, you may have a dormancy period of 5 years, and they're looking back 15 years. That's 20 years. So it can go back quite extensively, and many companies do not have records that go that far back, and they fall into the estimation fraction extrapolation that we talked about, which can be quite costly.
See another question here coming in stating that my business has no connection with another state. Is it possible for me to have unclaimed property owed to that state? And the answer is yes. You know, it really is dependent upon where the payee is located. That's the first order of priority. In addition, we have many businesses, you know, I think 80% or so of corporations are incorporated in the state of Delaware, but they may be operating in another state. So it's likely that there may be a Delaware unclaimed property report required. So yes, it is possible that you will have compliance in various states, even though your business may not be necessarily operating within those jurisdictions.
I've got one here. If a customer buys services advanced but doesn't use them in the time frame agreed upon, can the company recognize the revenue left, or does that have to be refunded? I mean, I think that you have to look at the particular laws involved in the state with respect to unclaimed property. That's kind of an interesting question. But again, it could fall back into whether you are entitled to that or not. If you contractually agree to something, you may have a case that shouldn't be escheated. It really depends on the state.
See another one here, interesting question. Is a contribution to a charity escheatable? And I would say no. There's no obligation to give something to a charity. It's not owed to the tax-exempt organization. As long as it's a donation out of the goodness of the business's heart, so to speak, there really isn't an unclaimed property issue.
I think a couple of questions here. One is, you know, if you've got a situation where the payee of the check is overseas, where does that get escheated to? Generally, in that situation, the answer is usually to the state of domicile of the particular business. If you can't locate the stockholder of a dividend check, basically, and you don't have the last name, known address, then it's escheatable to the state of domicile. Anyone else who has any questions? We're going to bring this to a close right now. If you have any other further questions, Alan and I would be happy to address those questions with you. Please contact us directly. Our contact information is in the presentation materials. Thank you, everyone, and we appreciate you listening in.